welcome everybody to this month's IMAP lunch. Again, we try to bring in a variety of speakers focused on ESG topics and helping share that research across departments within the university and with the external audience as well. Free lunch for those who come in person, and we're happy to have a number of you online as well. Without further ado, I'd like to turn it over to the speaker, Irena Vodenska, and come on in. I'll let you further introduce yourself.
Thank you so much. Thank you so much. First, I wanted to thank Susan and Deborah for organizing this launching, the seminar, and then for inviting me to give a talk, and also thank to all of you who came to the talk, and I want to thank the people who are online. The project that I'm going to talk about today is done in collaboration with Boston University, Metropolitan College, and Fidelity Investments. I see our advisor from Fidelity is online. Welcome, Mike. And this is done in the context of a capstone project that we had in the last spring. In discussion of what the topic of the capstone project should be, we were going back and forth on picking a topic. It was going to be in the ESG, or environmental, social, and governance arena. And at advice of our industry advisor from Fidelity, Mike Robertson, they proposed, and it was a great topic to adopt and research with several students, part of the capstone project course on corporate governance. Corporate governance is part of the ESG trio, but sometimes it's forgotten, so to speak. We hear a lot about the environmental issues, about disclosures, about regulations. And then the S, or the social part, closely follows with calls for improving workers' conditions. Amazon workers do not have to work in warehouses where the temperatures are 38 degrees Celsius. And so on, and large companies producing their products overseas, having production in not such good conditions. And the governance, it is part of this ESG, but it really has been there for the longest time, so to speak, or the focus on it has been there for the longest time, because even if we think about ESG, it's really the governance that trickles down how the other parts of ESG are going to be implemented or looked at. I'm going to go through some literature review briefly and some historical corporate analysis, and then I'll dive into what we pulled, our model, some of the results. These are preliminary results. The project is ongoing, and we have some ideas. After the discussion, I will talk a little bit about our future work. Just a brief reminder of the list that the corporate governance factors studied in the literature. At first, when we think about it, there's so many factors that influence whether a corporation is governed well or not. But just to give you an idea of how many of these factors have been studied extensively. Obviously, the financial indicators could give us an idea whether a corporation is governed well or not. Market to book value, dividend yields, the level of leverage, where the capital expenditures are going, how are they managed, volatility of the company, or on company performance, how the company is doing in return on assets, return on equity, Tobin skew, gross margin, profit margin. And then at board characteristics, the director tenure has been studied, of how long one sits on a certain board, ownership of stocks of companies where directors sit on the boards. The size of the board has been studied, whether there is an optimal size, is too small board bad, maybe too big board is also bad. And the board independence, and also various committees independence is important and studied. And then board-specific skills, whether they're finance experts on board, whether they're risk management experts on board, and then whether there is sustainability expert board member or not. Do we have and how many non-executive directors? How independent the compensation committee is, and how independent the directors are in general. Then a lot of studies as of late also started introducing analysis of how diverse the boards are. And not just the gender diversity, really all kind of diversity measures on the boards and in executive level or managerial level. And also the CEO, the management diversities. And in the capital structure, studies have also pulled the CEO stock sales, I would say stock trades, it depends on the direction. Purchasing or selling, this is of course, has to be reported and it's public information. Shareholding by 5 major shareholders, who they are, and existence of a major shareholder holding 20% or more of total shares outstanding. And then management characteristics. There are many that are studied. I just pulled a few. Whether the CEOs, this is their first year of in the CEO role, what age are they? Is there a CEO duality, or is the CEO also the chair of the board? And this is a common practice in the United States, but not in many other countries around the world. CEO tenure, how long, what their total compensation is, and how that is related to good or bad governance, their holdings, gender, and so on. And then the shareholder rights. Do the shareholders have a right to ratify external auditor reports? So if we go back more than 20 years, even the CEO and the CFO are not responsible, so to speak, to ratify or put their signatures on financial reports. It was the auditor's purview. And then we know what happened in the 90s. There were many accounting scandals, and then that really brought up the awareness. In 2002. We had the Sarbanes-Oxley Act, and one of the provisions in the act was actually that not only the auditors are responsible to testify that the financials are correct, truthful, and not misleading, but the CEO and the CFO had to sign off. It turns out it's important also the quality of the audit committee, and also if the firm is audited by the Big Four, that is related to good performance or bad performance. And then some governance mechanisms, managerial overconfidence or CEO overconfidence. I just remembered one paper, I didn't put it in the literature review, but it's one of the co-authors is Ron Masulis. He was at Vanderbilt Owen Graduate School of Management a long time ago when I was a graduate student there. And I was his research assistant, but now he's in Australia, but really works on corporate governance. And he just had a study on CEO overconfidence and what that means for decision-making, and also studied how potentially a female-dominated board or diversity, higher diversity rather, could influence this overconfidence to actually reduce the number of maybe questionable decisions to be made. So it's just about a balance, I would say. Then the ESG disclosure scores, we talked a little bit about regulation just briefly before this talk. It is a wild west out there about ESG scores. We have MSCI rankings, we have ISS, we have Bloomberg, Sustainalytics, and we do have ESG rankings for companies, ratings, but the correlation among all these providers is not that high. So, and this is not because one is better or the other is worse, it's just different methodology. There is no standardization yet. We're hopefully going to get there. There are lots of efforts to standardize, to increase transparency and increase comparability among companies. And then shareholder rights to approve the remuneration of executive management or sustainability reporting quality measured by the disclosure index according to the Global Reporting Initiative. So there are plenty of these factors that have been studied. I'm going to stop with this slide counting the factors, but just to give you an idea, this is a very well studied topic. It's not that people have not looked at it. And so this last one, we actually looked into how whether there are any indicators of potential fraud or whether some fraud cases can actually give us a glimpse if we go into a history and see historically the behavior of the boards or the management could be predictable to potential fraud. Actually, the SEC is very interested in this kind of study. There are teams there that are actually working on natural language processing and all analysis and machine learning techniques to study patterns, history in financials and also in the narratives of press releases or media to understand whether there could be some predictors of what is the likelihood of fraud. If some of the management had prior legal infraction, it may be indicative of potential future fraud. If there is ownership of luxury good or previous accounting fraud, if the culture is corrupt within the organization, it could be indicative. And then if there is some opportunistic insider trading and so on. And so there is also a look into, there is a corporate sustainability committee, corporate social responsibility committee, or we looked into different, all right. So just briefly on the literature, I'm going to go quickly. There was a study by Shackhill and et al. In 2020 of US banks, and they found that women directors actually contribute to pay more attention or attaining more legitimate performance in ESG by implementing different practices, proposing. Then Relia in 2022, they studied 35 US boards, board size, independence, diversity, meeting frequency, average age, and found that all these characteristics are significantly positively related to ESG disclosure, except for the age. Board average age was not related. And then Oyster et al. In 22, they studied 2,800 US non-financial companies between 2007 and 20, and found that diverse boards and optimal size of boards are negatively related with corporate violations. So the use of Big Four firms, accounting firms for auditing was associated with less corporate fraud. And again, this is after 2002 also. The sample is after the Sarbanes-Oxley. And then the share of females on board, interestingly, they found mitigates only certain types of corporate misconduct, the environmental safety, but it was not related to financial misconduct. They studied different kind of misconduct. And the corporate misconduct they found is more frequent when there is this duality, when the CEO is also a board chairman. Bahid, back in 2009, they studied 6,000 US listed companies for the 10 years between 2000 and 2010, and found that gender diverse boards exhibit less financial misconduct, and that firms with female directors are less likely to issue accounting restatements. Liu, in 2015, they studied 9,000 publicly traded firms in the US and found that corrupt culture is positively associated with incidents of corporate misconduct. So these are all logical conclusions, and certain things are related and others are not, depending, of course, on the study. But since we studied in our sample US and European firms, we looked into US studies and also European studies. So this is a study of Spanish firms, and Fernandez Temprano and Irena in 2020 found that age diversity of supervisory directors improves accounting performance, and that's the same for executive directors. And interestingly, they find that if it's a mix between older and younger directors, they complement each other in a way, and this complementing improves the asset management of the company. And Homroy, Mavrook, and Heng Wen in 23 were looking into Swedish firms between 2006 and 20, and then found that the CEO with ESG-linked pay improved the ESG performance, interestingly, without sacrificing financial performance. And the ESG targets are more common in well-governed companies. This reduces agency costs, and ESG contracting is a mechanism to incentivize wealth in ESG and ESG together. Welte, in their study in 2016, studied 1,000 German and Austrian firms between 2010 and 2014, and found that the gender diversity in the management boards positively impact the ESG performance. One more study, and I kind of pulled a lot more in this study because it was interesting to see. This is about, this is Davidson and al. In 2015, executives of the job behavior, corporate culture and financial reporting. So they related the off the job, the character, behavior, practices to the potential fraud. So this is a logistic regression. They were trying to get an indicator of likelihood of fraud, and they studied how many of these CEOs with this certain life habits or behavior outside of work is related to actually the fraud in the company. And so in all cases, there is a larger number of CEOs in the fraud companies where there is a felony drug charges or domestic violence or reckless endangerment or traffic violations. And if they own a car that's more expensive than $75,000 or a boat that's longer than 25 feet. So in addition to looking through all the factors that have been studied and the literature, in this collaboration with Fidelity, we actually looked into case studies. We said, okay, now we're going to dissect all the companies that we want to study. We looked into more companies, but I'm not going to talk about all of them today. But we looked at Facebook and Cambridge Analytica from the governance point of view. Luckin Coffee, Enron, known case, Tyco, known case. So they're famous cases where many people have studied in depth what happened and probably even know how it came to such large companies to get in so much trouble. But I wanted to look into these case studies very briefly because the idea of this exercise was to extract some factors that might not have been looked at before, and they might be important to understand whether good governance and bad governance is related to these factors. So the governance factors, some of them identified by this company review, is we looked at the financials. And so looking into earnings quality, one of the things that surfaced was if there are sudden changes in reserves, that's related to later on bad performance. If earnings don't correlate with the cash flows, so then we're going into the accruals, and we actually used the accruals as one of the variables. Earnings growth is too consistent. This was a little bit surprising for me because I was thinking, oh, don't we look for consistency, right? But this is the key word, too consistent. So just what came to mind then when I thought the second round around, yeah, Bernie Madoff's returns on all of the clients' investments were too consistent for too long of a time and too good to be true. So these are the things that are interesting to dig deep into, and whether they deviate from companies' peers or the industry norm. And then, of course, if there are any large, frequent one-time charges or gains. So I'm not going to go all over this, but it's pretty much like we dug into and selected what have we noticed and learned from these case studies. So misleading filings, or falsified underreporting, and failure to disclose. So it all came to what is really needed, what the companies are required to do. And they're not supposed to be telling half-truths. So half-truths are not legal. Or stopping at the material disclosure is not okay. And there were some other instances we found from these 6-7 case studies that we studied. But then it also turned out that if there are weak corporate policies, that's also trickling into bad performance. If there are criminal records in the past, or if there is a cash out of stock holdings by management, too big and too frequent. And then if there is registration of a company in a controversial country, that is difficult to research even. But this is one of the red flags when you think about con artists, like, oh, I have really this. Yeah, and it's really secretive. You're just part of the club. It's somewhere in the Pacific. It's one of these islands. I don't even know what their name is, but you're going to get 50% return next year. All right, thank you very much. So, and then some cash flow issues. One of the things that was interesting we pulled was if there is an extremely competitive work environment. This was another one that kind of caught my attention and said, well, we need to be competitive, right? Efficient. But again, it's too competitive or extremely competitive work environment. And then I remembered Wells Fargo. When all the account executives were pushed to open accounts because there was the check mark, and there were existing clients. Those were not even new accounts. So that's like the pushing or so on. And then unexpected CEO resignation, high level of doubtful receivables, and so on. These are kind of a no-brainer. When I go through it, I said, of course, this is related to bad performance, inadequate internal controls, or overly complex structure. However, it's important. I think what we did is we sat down and kind of catalogized the potential future study candidates for how to look at some of these indicators. And so on the company reviews, we're going to talk just very briefly on Facebook and Cambridge Analytica. And so, so the hope from making or doing these case studies was to learn of how far can actually a company go in denying what they did or didn't do. And I just pulled two very famous cases so that we don't have to go into details of explaining how it came to this. But interesting part about the Facebook and Cambridge Analytica case was that at the essence, at the bottom of it, it was somebody from inside Facebook basically just taking the data and giving it to Cambridge Analytica. How, what, and then Facebook management claiming that they had no idea about it. They didn't know this is happening. So it's a question. How do you not know such a large extent of a data leakage coming to a company at an opportunistic time when this data is needed for political reasons? Let's just say that was the reason. Maybe it was not, but it was used in that context. So then after denial, finally, the Cambridge Analytica use of Facebook data for campaign purposes and influencing the voters in the United States was exposed by Cambridge Analytica whistleblower, Christopher Wiley. And long story short, Facebook had a breach of confidentiality, data leak. It's a serious data breach of personal data of people. So there were many red flags along the way. The awareness by the management, but they did falsify the external reports. They knew. This is all, by the way, out of the investigation. So, and then the internal controls obviously were not effective, and there were misleading public filings, misleading press releases, failure to disclose, and ultimately that brought Facebook to settle with the FTC $5 billion and new privacy guarantees. It happened. So this is not, imaginary story. And this is when governance goes wrong. The other case is the Enron and the Enron collapse. This is a textbook story of failed governance. And Enron was basically in the 90s, probably one of the most prominent energy companies. They went into derivatives, futures trading. They were so popular. I was in a graduate school at that time. I mentioned it, Vanderbilt, and they were one of the largest employers. They were coming to campus. It was very prestigious to get an interview with Enron and from the finance department, and then work for Enron. So it was almost like, oh, Jack got the job. Jack got the job offer with Enron. This was in 96, 97. And that lasted 4 years for all the graduates who got these jobs. But going from being seventh largest US corporation and 63 billion of market capitalization, even though when I see this 63 billion now, it's like compared to today's market capitalizations, I was thinking, am I wrong? Is this like, am I missing a zero here maybe? But so, okay, this is 25 years ago and it was right. And then people lost their pension benefits because they were also asked to invest in Enron stock with their 401ks and so on. So it was a big scandal, and it's a very well-known scandal. And what caused it? So hiding, basically. It's again something that you said that the SEC requires you to do this, and you need to disclose your liability. It's very simple. It's very basic. But they hid it, and they did not. So that is a one-on-one case of bad corporate governance. And then the other practices, or the mark-to-market accounting, just like the with the accruals estimates, these are also estimates. But then how wrong or how right? Do you have any range you get it? It was not very well estimated, to say the least. And they recorded transactions incorrectly, not even in accordance with the GAAP. And so then we know the end of Enron, and in 2001, the company collapsed. So some of the factors that we pulled from this case study was ineffective stock compensation program, and there were conflict of interest from third parties. This is again before 2002, before Sarbanes-Oxley. And Arthur Andersen was not just the auditor, but they were their consultant. So this is again one-on-one conflict of interest. And sometimes we think about, you don't even need regulation. Somehow you need to know that this is a conflict of interest, because probably the largest non-auditing fees that corporations are paying are consulting fees. So auditing doesn't cost that much, but consulting is quite lucrative. Okay, after the fact, maybe I'm talking so. Okay, so red flags, CEO resignation, illusory revenue growth, There were declining profit margins every probably single quarter for the last several years before the company collapsed, and the profit margin was significantly different from the industry average. They had positive accruals, negative free cash flow, and so on. So now to dive into our study. We put together these three hypotheses. One is that firms' poor financial considerations, such as having accounting investigations, positive accruals, related party transactions. This is when the company gives loans or has some transactions with the executives, negatively affect performance. So this is around the financial considerations. The second hypothesis was around the composition of the board of directors and committee independence, women in leadership positions, whether they have finance and risk experts on the board. And the hypothesis is that if they do, that's negatively related to risk. And the third hypothesis is about policies. If there is a CEO or director's equity policy, if they have poison pill, they have clawback policies, that these are negatively related to risk and positively related to return. So we put all this, we did a lot of various combinations and studies, but the bottom line was we wanted to pick two performance measures out of many and pick two risk measures out of many and see how they are related to the financial considerations, the board composition, and the policies that that companies have. So we studied 600 public companies. 70% were from the US, 30% from the EU, between October 2009 and February 2023. And almost, good coverage of the sectors: communications, consumer discretionary, energy, financials, technology, materials, real estate, utilities. And the EU sample was from the developed European countries, because also the data is the best from when you look at the developed European countries. So it was a good beginning sample. Obviously, in our future work, we would love this sample to expand into several thousand companies. But so for right now, we looked into the accruals, the related party transactions, accounting investigations, and non-audit fees from the financial considerations. The audit committee independence, compensation committee independence, finance experts on audit committee, risk management experts, women on board from the board composition, and from corporate policies, we looked into CEO equity policy, director equity policy, poison pill clawback, and then looked into the net income and gross margin on the performance side, and drawdowns and volatility on the corporate risk side. And then we continued to dig into how the governance scores and ethics scores are affected by financial considerations. So it was a panel data regression approach, and we took the sales as a control for the companies were obviously of different sizes, and then some of the results I'm going to share include on the performance side. This is where the accruals were, I highlighted and put the red around it, and I was actually having in mind to ask even about what we already discussed about where these differences might be coming from and what your opinion is, but they are positively related with the gross margin in the US and negatively related with gross margin in EU. The number of financial transactions in the corporation of third parties or related parties was negatively related to the performance, and it's only significant in the US. It was not significant for the European sample at all. The independence of the audit committee was a peculiarly coded variable. And it was coded one if the committee was not independent. So this is why I said not independent audit committee is negatively related to performance. And this is also, again, just significant for the US, and it was not significant for the EU. The Independent Compensation Committee, again, the coding was not independent, was one. And if it's not independent, it's negatively related to gross margin, also only significant for the US, not significant for the EU. Interestingly, the number of financial experts on the board was positively related to the gross margin of the US, but negatively related to the gross margin in the EU. This is another one of the mixed results. And then the women on board was the third variable where we saw mixed results in different performance measures for the different regions, for the US and EU. And it's interesting because there are both positive and negative relationship, just different measures in the US, and also positive and negative relationship, different measures of performance for the EU. So these three for right now are something that I think we're kind of taking notes and saying we really need to dig deeper and see what is going on and where is this coming from. But the director tenure, if they're directors or with 10-year or more tenure on the boards, were positively related with the net income in US and net income in EU. And the CEO equity policy, if there was a CEO equity policy, is positively related to the gross margin. So this is across the board. It seems that having this policy, equity policy, is across the board significant and positively related to performance. This is another one of those, if there is no director equity policy, it was one. So if there is no director equity policy, then we find negative relation with the performance. So in essence, it's the same, meaning that if we have equity policy for CEOs, if we have equity policy for directors, that's positive for the performance across the board for EU and for the US firms. And in regard to risk, we looked into the drawdowns, basically took the stock prices for a month. We created monthly drawdowns for all the companies. And we took also daily volatilities and created monthly volatilities for each company. The accruals were positively related to drawdowns for EU. And remember, they were negatively related with performance. So this makes sense if you look the risk and return as something opposite. But no significance in the US or in the overall sample. It just European sample with the drawdowns. And then for the not independent audit committee, this was negatively related to volatility in the US and positively related to drawdowns in EU. So these mixed results are the most puzzling to me. And also I think it's a good study to really understand the background, to understand where they might be coming from. And so the women on board were positively related with risk, drawdowns in the US, and then with the drawdowns and volatility in the EU. And then the no director policy was negatively related to risk for the whole sample for the US and especially for volatility. This is the last slide before the discussion and conclusion. This is looking into how the financial considerations are related to the corporate governance score and the ethics score for all the sample, for the US sample and the EU sample. And I just looked at it and I said, in all of these, there are two insignificant coefficients. It was interesting to see that even though there is a difference between the signs for US and Europe. Actually, there is a difference between the corporate governance score and ethics score. They are all significant. So again, question is, when you dig deeper into how the corporate governance score is defined, and it relates more to the board characteristics, the type of compensation considerations, and the ethics score is more of a how the maybe working environment is for employees, or how the compensation for employees work. So they are different, but it was interesting to see that financial transactions or accounting investigations are across the board negatively related with both scores, which makes sense. And the fees, the non-audit fees, are across the board negatively related with corporate governance scores and ethics scores. So these are the last ones, the last three, the financial transactions, accounting investigations, and non-audit fee, are the takeaways from the point of view of their negative relation to the corporate governance or the ethics score, and across the board in the US, in EU, all with the same signs. So just to conclude, some of the observations included the higher accruals, which is typical measure of low earning quality associated with low net income. The independent audit committee was negatively affecting financial performance, but not significant to corporate risk. Having financial expert positively affects net income, and there are various transactions, if they're with the individuals or entities closely connected to the companies, that's negatively related to the gross margin. And also the differences between US and Europe. While the higher accruals were negatively related to financial performance in the US, they're positively associated with the performance in the EU. And there was a difference also in having financial expert on the board between EU and US, positively associated in the US and negatively to the gross margin in the EU sample, and the transactions by related individuals and audit committee independence significantly negatively affecting performance only in the US. This was not observed in the European sample. So some of the future work we already started looking into. As I said, we divided we look into cross-sectional now, we're looking into 2019 and 23, but we explore some interaction terms between the diversity on boards and executive positions and the company size. And maybe there is a difference, how much influence can diversity contribute to any performance. We look now into the 1-year distance to default and women on corporate boards or female executives. And we'd like to expand this study obviously to follow up times, and in the light of a different regulatory environment between the US and Europe, and then look into the timing and nature of regulations, voluntary versus mandatory, and how that might be related to corporate governance, and then expand the corporate governance considerations to Asia, Latin America, highlight cultural differences, maybe even from origin, cultural origin. People come from different places, they have different points of view, different background, education, environment where they grew up. And that will conclude the presentation. Thank you so much.